places that are notably weak is, Japan is notably weak with negative GDP growth, a couple of negative GDP growth prints. Canada is weak with near zero or slightly above zero growth in an environment where they have relatively significant labor force growth. And of course, China has been stagnant for multiple years.
You also have a lot of other currencies weak against the dollar. The dollar index has been relatively strong. It's at 104.30 when we're recording this interview. But you have a lot of other currencies, I would say, that are very, very weak against the dollar, especially like the Japanese yen. But there's a lot of emerging market currencies the last 6 months that have been very weak against the dollar, too.
Yeah, well, I think that really highlights the divergence of what's going on economically. I mean, look, the U.S. is outperforming essentially every other major developed economy. And as a function of that, is in a position where the U.S. needs to maintain tighter monetary policy for an extended period of time relative to places, a place like Japan, which, has inflation that's below their target, back below their target, and negative GDP growth, which is likely going to have, very weak growth for, very weak or stimulative monetary policy for an extended period of time. So those circumstances are firmly in place and are putting pressure on exchange rates, mostly for the dollar to be stronger relative to the rest of the world. And from the U.S. perspective, there's not really much consequence of a strong dollar. On the margin, it's detrimental to exports, but that is a very marginal effect. If you're sitting in the Fed shoes, it doesn't really matter if the dollar continues to strengthen because U.S. monetary policy remains tight relative to the rest of the world. Domestic economic strength and the need to have tight monetary policy continue matters a lot more than any impact from the dollar.
Do you think that these other foreign central banks, are they worried about the dollar rallying because they have dollar denominated debt and they have a lot of domestic inflation if their currency is getting weak?
Well, I think there's a big difference between how different economies are looking at it. If you're Japan, where you have very minimal foreign currency debt, the decline in the currency isn't really a structural problem. On the margin, is actually supporting what would otherwise be inflation that's too low. And so it's not clear. There's obviously financial stability concerns, and you don't want your currency to be plunging, and so that's why they intervene every once in a while to sort of take out specs who are over levered in short positions. But the BOJ is fine with currency depreciation. If anything, probably pleased a bit with it. I'd put that in contrast with what we're seeing out of the PBOC, where China has some dollar-denominated debt. That's not really the big problem. The big problem for China is that there is significant desire to save in dollars and real channels to be able to do it, given the amount of trade that's going on. And so households and corporations are really desperate to move money offshore in one form or another, which is putting pressure on their currency. With everyone recognizing that China needs much more stimulative monetary policy to even get relatively acceptable economic growth ahead. And so, people are figuring out ways to prepare for negative pressure on the exchange rate. And the PBOC is playing a bit of whack-a-mole to try and slow that down. And they're not doing it so successfully. They've had to intervene massively in order to just keep the currency where it is today.